Hello guys, welcome back to my YouTube channel. In this episode we're going to be talking about trade management, risk management and money management. I'll do my best to break those three concepts into this one video, so I don't want this series to get too long, so we'll see if we can have them all in this video. I'll also be showing you guys my own performance, trade performance for this past couple of months, so you guys could see how risk management could save your account. If you've been in the trading game for a while, you know that there are going to be times where you go on losing streaks. There are going to be times where maybe your psychology is not right, and if you are not managing your trades properly, you're just going to lose your account. So in this video we're going to be going over all the little things that you should know, all the ways that the nuances you could use to manage your account to give you longevity in the game. Watch through the end of the video because I'm going to be sharing how to use risk management if you're a prop firm trader, how to also do it if you're trading your life account. There are different tricks and systems that you could put in place, so that you could give you the confidence to take your account to where you want to get to. The way you trade prop firms are not necessarily the way you trade your normal account, so we're going to be highlighting those in this video. So without further ado, let's get straight into the video. First we're going to be looking into risk management. Okay, let me just type it out. Risk management. Okay, I've said this a couple of times, or you guys have heard me say this a couple of times. Trading is all about probabilities and never about certainty. If you listen to people online speak about their trades, it's almost like sometimes it gets to sound like as if they know exactly what the market is going to do, but at the end of the day, what trading really is in its core is we as traders, we are always playing the probabilities. Okay, so when I talk about probabilities, it just simply means that there's a probability that the trade could work out, and there's a probability that the trade could not work out, may not work out. No matter how great your strategy is, no matter what you wait for as your entry confirmation, no matter who you are as a trader, unless you do not want to come out and admit the truth, you will have losing trades. What makes a successful trader different from a gambler is your ability to manage risk. That's what makes trading a safer option to gambling. Is you have the ability to choose, this has gone below where I'm expecting it to get to, I want to get out here. You have the ability to choose your risk even before getting into the position. So we're going to go over some of the systems or the techniques we can use to determine our risk and for our accounts depending on your account size. I'm assuming these people who are watching this you are more in the beginner stage, or maybe you're advanced but you have never really looked into risk management. You're just trying to get familiarized with risk management. Okay, let's say for example I have an account size of let me just use a nice full round number, $10,000, and I am a fantastic trader. I have a win rate of 90%, which means that if I take 10 trades, I'm going to win 9 and lose just 1. That is very rare. You are an anomaly. But let's just say you have studied the market so well, you know exactly what the market is going to do 9 times out of 10. You're a fantastic trader. But just because you know what the market is going to do 9 times out of 10, every single time you want to take a trade, you risk your $10,000. You risk your $10,000. Say you are successful. So in this example, we are assuming that if you take 10 trades, you are going to lose 1. Let's just say, for example, your first trade is the trade that you lose. Can you see that your $10,000 has gone? It doesn't mean that you're a terrible trader. It doesn't mean you do not know what you're doing. It doesn't mean none of that. You could be a fantastic trader. You could be the best trader in the world. But you fail to manage your risk. You put all your eggs in one basket. You put all your capital on one single trade. That is poor risk management. And that will get you out of the trading market very fast. Say you risk 50% of your account. You make the first trade successfully. So now you are up 15,000. You risk 50% again. 15,000. You make the second trade. Wow, you're up 20 something thousand. You risk 50% of the account again. Now, on that one trade, you lose half of that money. What do you think that will do to your psychology? Do you think you'll be able to come to the market the next day with the same clear mind that you have been coming to the market with all through? Obviously not. And this is the area where traders find it difficult to really zone in. Sometimes you might still be struggling, not because you do not know the strategy. Your strategy is on point. You know your entries, you know structure, but you still have not gotten your risk management down pat. That's what we are going to be tackling today. So for this video, to keep it very systems based, okay, most people will tell you to risk 0.5 to 1% per trade. It means for a $10,000 account, 0.5% of $10,000 would equal $50 to $100 per trade. Now I know a lot of people will be like, I have 10,000. Why am I risking just $50? Why am I risking just $100? I beg, I'm in this game to make money. I'm not here to waste my time. But just bear with me, okay? Especially when you're starting off. Risking 0.5 to 1% per trade is going to give you, you're going to remain calm and trade objectively. Fine and good, everybody have their own different risk tolerance, and I personally believe you begin to talk about risk tolerance and all this stuff when you have been able to successfully move from this beginner mindset, and you'll be able to trade your strategy and be able to make profits. That's why you'll be able to say, okay, I have this strategy down packed. I want to up my risk. I want to do this. But when you're starting out, and these videos, I'm doing this series for people who are starting out, or people who have learned but have missed this part of the information in their education. Okay, when you're starting out, it is advisable to go with a 0.5 to 1% risk per trade. until you have at least, in fact, me, I would recommend you go with a 0.5 risk until you have some buffer before you can increase your risk up to 1%. Here's why. Trading is not just about strategy, entries, exits. When you're dealing with money, emotions tend to get involved. Emotions tend to get involved. When you have your risk at a certain cap, you can focus on what you see on the charts. You will definitely have losses. I will never come here and tell you, oh, I'm going to post a screenshot of my performance for the past couple of months. In fact, you find out that I have a lot of red trades, a lot of trades that, because different things were happening in my life. Sometimes my psychology was not in the right place. I was going through different things and I was just putting it out on the market, and I was taking loss after loss after loss after loss. But still, I was able to come out, recover from the losses, and even pass my account. Why? Because even while I was taking loss after loss after loss, my risk management, I was staying on point with my risk management. I was making sure I was never losing more than 1%. I was making sure I was never losing. I had like a 0.5% risk when I'm, down. Like this, we'll get into that when we start talking about trade management. Okay, but as for risk management, risk is the amount of money that you are willing to put on the table from your capital. So always start out with a 0.5% risk, and 0.5% of $10,000 in this case is $50. 0.5 to 1% risk. 1% of $10,000 is $100. Now, if you have been making successful trades, you are up, say 3%. You're up 3%. You can now increase your risk from 0.5% to 1%. Knowing that if you lose, you have to lose 3 trades in a row to come back to break even. Break even means to come back to your normal capital. Okay? 0.5 to 1% risk per trade. So just I'm giving you guys the percent because your account size may not be $10,000, it might be $100,000. You won't use $50 or $100. You just take the percentage value and figure it out on your account size. On your account, if your account size is $100,000, then 1% would be about $1,000, and 0.5% would be like $500. Okay, so that's why I'm speaking in terms of percent. In fact, let me write it here. 0.5% to 1% per trade. Okay, this is the risk management I would advise that you stick with, especially when you are starting off. Now, it doesn't matter if you're using a small account. Oh, my account is just $100. Do I still? If you build the skill in trading, the money is really not the problem. If you build the skill in trading, the money is really not the problem. So even if you're starting out with a $100 account, I would advise you start off. Make sure you prove to yourself that you're able to be disciplined. You're able to be disciplined with your small capital. With the $50 account, $100 account, you're able to be disciplined and stick to risk management in that $50 or your small capital. If you're able to do that, then instead of trading $50 to trying to flip your $50 by risking so much, now you can take that $50 that you have been able to build. If you have done 10% on your $50, you have proven to yourself now that you can stick to your risk management plan. You can use that $50. There are many options of getting capital. You can look for a reliable prop firm out there to buy. You can get investors. As long as you are able to have the skills down pat, your your risk management and your strategy, you're able to tie those together, you can always get capital. So your risk management for starting off, I advise, is 0.5 to 1% per trade. You can always raise this percentage up, but you only do that when you have given yourself more equity. You started off with $10,000, now you are up 10,400, and you decide, oh, I want to take my risk from 1% to 1.5%. You have the equity to play around with. It's always tasking when if your account is $10,000 and you are trying to go high risk, you're trying to go 2%, 3%, and you give yourself a drawdown and you're trying to trade up from a drawdown. Emotionally is tasking. So that's why I prefer you trade up your account or use proper risk management and build up your account, build equity, then you can increase your risk. I hope this gives us a little bit of understanding on risk management. Now let's go over to trade management. Trade management. Now, this simply means your ability to manage your position when you are in a trade. Okay, your ability to manage your risk when you are in a trade. Now, if you have been following my channel, you would have heard me say I always go for a risk to reward of 1:3. Now, what I don't think I've ever mentioned in any of my videos is any of my trades that hit a 1 to 2 risk to reward, I cannot let it turn to a loss. What do I mean? Let's just say, for example, I have let's keep it uniform, $10,000 account, and I risk 1%. Okay, if I get into a position, it means from this analogy here, it means I'm risking $100. If I am expecting my risk to reward, I want to get out of every trade is a 1:3 risk to reward. Okay, this is what my typical trade, and this is what I'm going for my typical trade. But my trade management, if my position moves from 1% and it gets to 2%, I would never let that trade come back and hit my stop loss. Which means I will move my stop loss from where it is to my entry or above my entry once my trade hits a 2-to-1 risk to reward. That is my trade management strategy. So if I'm expecting my 1% here is $100 and I'm gunning for 3%, which is $300, and my trade moves from $100 to $200, I would never let that trade come back and take me out on $100 loss. As soon as it hits $200 mark, I will manage my position, meaning I will move my stop loss from where it is to the entry. So if this trade reverses on me from the 2%, I will come out of the trade without a loss and without a profit. So let me type this out. At 2% profits, I move SL to BE. I move stop loss to break even. This is my trade management strategy. Now, if you're following the strategy I gave you guys based off entry or based off my last video, I told you guys you can just go for 2% and this will be a hard stop. Now, since you're not going for a 1 to 3, your trade management strategy could be any trades that moves up 1.6% in profits. I will move my stop loss to break even, so I do not get to lose that trade. Because sometimes you find traders and people's trade management can differ. I'm just giving you guys a simple system that you can follow, that anyone can follow to start off. This could be your simple template, and then you get advanced and you decide to switch up a couple of things. But for your beginning stages, you can follow this template and go from there. You see people, my take profit is I'm going for a 1 to 2.5, and trade has moved 1 to 2.4. It means I'm risking $100 to make $250, and now I'm watching my trade has moved from $100 and is at $240, and I leave my stop loss and the trade reverses and comes back and takes me out on stop loss. That cannot be me. Unless you have, that is your trade management, you do not tamper with your trade once you're in the position, fine and good. But the first rule of trading, the first thing you should think of trading, even before making profit, is capital preservation. You should always make sure that your capital is preserved. So if I'm expecting a trade to move 1 to 3 and the trade has moved 1 to 2, I'm expecting a trade to give me $300 and the trade has given me $200, and I allow the trade, it has doubled my money, my risk already, and allow the trade to come back and stop me out. It just means that I'm not protecting my capital. I'm missing out on the first rule of trading. So to me, I will always protect my capital when my trade has given me a certain percent of the profits, of the entire profits I'm looking to take. I won't close the trade entirely, because I still believe that my analysis is going to play out and the trade is going to go in my direction. But again, it's probabilities. Just in case it doesn't work out, I want my capital to be protected. That is what risk management is. You doing your best to protect your capital, protect your risk. So again, using the percentage is going to be easy. So depending on your account size, I use an example for $10,000, but your account can be $100, can be $1,000, can be $500. You just use the percent and not the dollar amount. You use the percent to determine what your risk is or how to manage your trade. The last thing we're going to talk about is money management. Money management. Okay. Money management is simply your ability to manage your capital appropriately. Trade management is your ability to manage your risk. Okay, you have a capital of $10,000. You put up a risk of 1%, which is $100. Your trade management is your ability to manage that's your $100 to make sure that you do not try your best to have a way of protecting that your $100, that your 1% capital, that your 1% risk, especially when you are up in profit a certain percent. Now, money management is your ability to manage your entire capital. That is this whole $10,000. Now, your money management strategy is what will tell you your full capital is $10,000. you do not enter a trade of $10,000 or $5,000. That is too much risk. If you're trading a personal account, let me find a way to explain this so that everybody can follow up. If you're trading a personal account, let's say you have a personal capital of $1,000. That is all your savings. All your savings is $1,000. Let me write this down so I can easily illustrate it. $1,000, and you're just starting off in trading. The way I would have you apportion your capital, I would have you use your $1,000. I would not have you put all this money in one trading account and try to trade it, especially if it's your first time or if you're just funding your account for the first time. Let's say you've been trading demo, you've mastered your strategy with demo, and you've been doing wonders in demo, you've been flipping accounts, you've been doing all these things. Why is that? Like I said before, trading has to do with money. Money has to do with emotions. You get emotional when you're trading, typically. Okay? You learn to manage your emotions, your psychology. You grow. Everybody grows. Everybody, is a stage that every trader needs to grow from. Okay? Now, if you put all your capital in one account and begin to trade it, you're going to be very emotional, and you're going to have very emotional reflexes. Okay? Let's say you, instead of risking 1% or you risk 1% and you made 3%, and now you feel like, oh, I'm getting the strategy, let me up my risk to 5%, and you do that. Now you're risking 5% and you lose that. This is your real capital. There's no how you tell me. And again, you're a beginner, you're starting off. It's going to touch you somewhere. And that's the worst thing that can happen to you when you're trading. You being emotional. You not looking at the market from a logical point of view. You looking at the market from an emotional point of view. That's the worst thing that can happen to you. Because the moment you start to take emotional decisions, man, you're going to definitely blow your account. So the way I'll have you set up your if you your first time and you have a capital of 1,000, I'll have you split this $1,000 into 3. Split it into 3. You split it into 400. This in the brackets. $400. $400 and $200. Split this $1,000 into 3. Now, first of all, put this $200 into your trading account. So now you have what is left of your capital, of your entire capital, is $800. But now you're trading with $200. You're giving yourself, you're bracing yourself up emotionally to handle this capital. You're giving yourself a good management system. Now, if you're able to trade this $200 and you're able to be disciplined, trading this $200 account, you are able to trade it properly, you have your strategy down packed, you're following all the rules, and you're able to trade this $200 consistently. I don't care how much you make, you could do 5%, 4%, as long as you're disciplined with trading this $200, then you can add $400. to the $200. Trade that again. All you're trying to do is protect your capital. Trading is first capital preservation before profits. And I know there are many people online, many gurus, who come online and show account flipping, which is not wrong, which I'm not against. But the problem is that tends to be the thing that would attract beginner traders. Oh, if I put $1,000 here, I can flip it to $100,000 in 5 trades. Wow, that's not trading. Because risk management down the drain, trade management down the drain, money management down the drain. So if that's the idea that you're coming into the market with, you have a 99% chance of blowing your $1,000 investment or capital. So the best thing for you to do is split the capital into 3, put $200 in, trade that for a while. Make sure you are following your discipline in your risk management and your trade management, and you're doing everything you're supposed to do. If you do that for a while, you make some money, you make some profits. You can add $400. Now you have increased your capital. See how you take it emotionally. Trade that. You do that, you add them. Now you have build capacity to be able to trade your $1,000 properly. Now you can be sure that you're following a good risk management, you're managing your trade properly. Now you can manage your capital properly. Some people like to skip the steps. They will just go. Sometimes they will borrow money, take loans and put into an account. You have just been trading demo and you take loans and you put it to an account and you start trading and you mess up, you get emotional and you mess things up and begin to run away, run from people in your area, run from family members, because you fail to understand the concept of trade management, risk management and money management. So if you're able to learn a strategy, this is another essential part of your strategy. So while writing out a trading plan, while writing out what your strategy entails, you should also be able to write out in detail what your risk management plan is, your trade management plan is, and your money management plan is. Now, in the beginning of this video, I said I was going to give you guys a strategy for prop firm traders, because I also trade prop firms. I trade prop firms, and that is essentially what I trade. So the risk management I employ, or I would advise you employ, is still the same, 0.5% to 1% per trade. Most prop firms have a daily drawdown of 4 or 5% and a target of 8%. Now you say, oh, if I reach 0.5, when do I want to pass the challenge? Like I said, the aim of trading, or the goal of trading first, is capital preservation. Especially when you're starting out, or you have traded demo, or you have made money in demo, now you want to try it out. Do not rush yourself. Do not go all in. Start out with 0.5%. Build equity. Say your account was with like a $10,000 account, and you are meant to make 8% with a max daily drawdown of 5% and a max drawdown of 8%. If we're going to be honest with ourselves, as a beginning trader, even if you're traded demo for a while, you've never actually handled real money. So there are still some mistakes that you are going to make in the markets, which you don't even know about yet, because you have never actually handled real money. The real emotions of trading real capital has never hit you. So now when you're doing all these things, those trades, those mistakes will tend to come out. What would protect you from losing your account in those periods is when you have a proper risk management in place, a proper trade management. Okay, so start off with the 0.5%. When you have built equity up to 2%, you can increase your risk per trade to 1%. If you increase your risk per trade to 1%, you build an equity up to like 5%, then you can increase your risk to 1.5%. Now, if you start with 0.5 and you take a loss or you go into drawdown, stick to 0.5%. This is what is going to protect your capital. You have a max daily drawdown of 4%. You should have a personal max daily drawdown per day. If the max daily drawdown is 4%, it could be I only take 2 trades per day and I risk 0.5% until I get to 2%. So if you risk if you take 2 trades and you risk 0.5 per trade, you have risked 1%. And if you lose both of the trades, you're out of the market till the next day. This will help you to avoid over trading. This will help you to preserve your account and draw you out from drawdown back into break even, or help you carry your account to the target. Now, the trade management, like I said, if you have a strategy of risk to reward of over 1 to 2% RR, when your account is at 2%, move your stop loss to break even. If your risk to reward ratio is 1 to 2, when your account is over 1 to 6%, move your stop loss to break even. This will protect your account from more losses. I would rather a trade hits my break even stop any day than it comes and takes out my full stop loss. So it's not about bragging rights. It's not about stop loss or take profit. I see that a lot. It's not about bragging rights. This is your trade. This is about your capital preservation, your ability to make money in the market. So it's not about bragging rights. Leave that by the side. Focus on the strategy, focus on the plan, focus on the trading plan, and plan the trade and trade the plan. Okay, so if you're going for a 1 to 2% RR, once your trade has gotten to 1 to 1.6, move your stop loss to break even. If it doesn't hit your take profit, at least let it not take out your stop loss. Let it hit you out, take you out at break even. This is the risk management and trade management I employ. This is the trade management and risk management I employ. Now, for money management for my prop firm account, it's the same thing. I have a maximum amount I allow myself to lose a day. I do not let myself lose more than 2% in a day. So it means if I risk 1% per trade, I do not take more than 2 trades per day. If I have a $10,000 account, I do not lose more than $200 per day. I'm preserving the capital to go again the next day. Because losing streak is part of trading. You're definitely going to have a losing streak no matter how good you are. Now, even worse when you're just starting off. It means there are some things that I would see that will prevent, that I'll be able to prevent, that you would not see. So to protect yourself from all those things, let them happen. Them happening doesn't make them wrong. You're going to learn from them. What makes it wrong is when you lose your entire account because of, you are not managing your risk properly. You're not managing your capital properly. So that's all the tips I have for you guys today. I hope this video is not too long. I'm trying to compress all the ideas in one video because I do not want the series to get too long. But yeah, I feel like these tips are going to be able to help traders who have been struggling or who have been looking for a system to apply to take their trading to the next level. So thanks guys, thanks for watching. Like, comment, subscribe. If you have any questions, leave them in the comment section. You can also hit me up on my social media platforms. I'll leave them in the description below. and I'll catch you guys in the next one. Bye for now.